in the first lessons, I will tell you what is the volume and the difference of the volume in the finance markets. And the last one, I will explain to you why is the volume important and which market will be suitable to apply volume analysis. So let's get started. The first one, what is the volume? Very simple to say, volume is the amount of assets units already traded during the given period of time. For example, 1 million stock of Apple already traded during the day, or 1,000 Bitcoin were traded in one day. And that value is the volume. You can understand very easily. And why the volume is changed during the days? And you can see that when the buyer and the seller jump into the market, the volume will be changed because the volume is the total assets units. Therefore, when the buyer and the seller buy or sell in the market, the volume will be changed. And when the volume was changed, it means that the price also changed because the difference between the buyer and the seller already set in the market. Therefore, very important, we normally use the volume to confirm the price signals in the market. And for example, here is one of the price chart in the market, and you can see how the volume appear on the market. I get example on the Apple stock. You can see here is a price chart with a candlestick, and below is the volumes. We have two colors of the volume, is a green and red volume based on the color of the candles on the upside. The color of the candle based on the close and the open price of the candles. Therefore, we can have the volume appear like this on the chart. And you can see one value is very normal to use in the volume analysis is the average value. For example, we calculate the average volume of 20 periods, and black line will appear on the market, and that is totally about the volume. Very simple, right? And the second one, I will tell you the difference volume in the finance market. We have two types of markets based on the liquidity, just a percent of change during the day, and therefore I will separate like the stock market, cryptos, and bond in the one type. And the second one is forex market. When you talk about liquidities of the stock or crypto markets compared with the forex market, the forex market is very bigger compared with these things. Normally, as forex market liquidities is higher than 50 times of the stock market in the world, and the percent of the trend during the day of the forex market is only 0.5% during the day. I mean the average value. When the stock market is only 10% of the day, and crypto is just from the 5 to the 20 or might be 100% during the days, because crypto has very high fluctuations. Therefore, we have two definitions of volume. The first one is actual volume. Actual volume is the definition on the first page is total assets units were traded during the day, and the tick volumes is a measured number of times price go up and go down. And you know about the definition of the volume. It is the buyer and the seller join into the market, and when the volume changes, the price also changes. Therefore, on the forex market, they calculate, they measure how many times price already changed during the period. Therefore, they will be applied to the volumes, and the correlation between the tick volumes and the actual volume is quite high, higher than 90%. Therefore, no problem if you want to apply the tick volume in the analysis. But due to the liquidities and the percent change during the day, I just recommend you only apply the volume analysis on the stock market, on cryptocurrency, to analyze, to double confirm the price signals. Because as I said before, we have two types of markets. First one is the forex market and other markets based on liquidities. Liquidity very big. It means that market is a continuous market, have no any interrupt during the day. But on the stock markets, for example, like this, depend on the funds, depend on the investor, depend on the trader join into the market. If more the trader, the funds, the investor join at that levels and appear the signals, that signal is a real, that signal is a true, you can join in the market. but have a no more present, it means that signal is not strong enough to you to join in the market. But in the forex market, the liquidity is very big. Therefore, any appearance signals, this is a very good signal for you to trade. That is the difference between the continents market and other markets. Therefore, that's also a reason why I recommend you only apply volume analysis on the cryptocurrency market, on the stock market, on the bond commodity markets, and on the forex market. Only use the price analysis is enough and simple to get profits. And that's also all about the lesson today. Thank you and see you next lesson.